DBRG, DigitalBridge Group. I'm doing a full review, or at least a back test review. If you're one of my members, you can request me to do this live on the show and then make a video from it. So if you are one of my members, request a back test and you can have it. We are looking at DigitalBridge Group. It's the first time I've ever looked at it. We're going to look at what I think of the company, what it is, does it have potential, what's its likely outcome, how I feel as far as an investment for myself, a price target perhaps. We're not going deep dive into the financials. We are looking at the fundamentals, what it is. We're comparing it to the S&P 500, looking a bit at the history, some basic information, but it's an introduction for the very first time to DigitalBridge Group, and I am actually reading it for the very first time as I talk to you. So here we go. Consider subscribing to the channel if you are new. This is the first time, brand new. We've never done DigitalBridge Group before. Let's have a look at it. So what is DigitalBridge Group? I've got their website here. The website looks very exciting. Accelerating the digital revolution. Okay, let's have a scroll down and have a little look at what the company is. DigitalBridge is a leading global alternative asset manager dedicated to investing in digital infrastructure, data centers, fiber solutions, macro cell towers, edge infrastructure, small cell networks, need for faster connectivity, high demand for digital infrastructure. Network demand is mission critical, built around a unique vision. 72 billion under management, 47 portfolio companies, 100 plus digital infrastructure professionals, and 25 years of results. Okay. That's the website for DigitalBridge Group. Let's now look at a bit more detail. We can just zoom into this information here. Will give us some information on Robinhood. It's a little bit of a breakdown. A digital group infrastructure company that engages in investing in digital ecosystem, including cell towers, data centers, fiber, small cells, and edge infrastructure. We've just spoke about. The first thing I like to do is know who the CEO is, so I go and find out who that is and see what their experience is, what they've done, what they've achieved, and how they're going, and all the rest of it. Employees 300. Okay, it's based in Florida, Boca Raton in Florida. Been around since 1991. Let's have a look. Market cap of 2.6 billion. Price to earnings down 7.83. So that means it's currently losing money. So it's negative on price to earnings ratio because they're actually losing money. It does have a dividend yield though, 0.26. Not very much. Sounds a bit like Apple. Apple's around about that. It's low. 52-week low is 1844. Its high is 1844, and its low is 999. Now let's have a look. Now the analysts have given it a 100% buy rating. No sells, no holds, 100% buy rating. Well, that's always encouraging, but you can't just go on that because it would be too easy, wouldn't it? Anyway, how are they doing over time? They used to back in 22, they were losing $1.84 on a share. That popped up to nearly flat, and that was the expectation, was to be flat, but it was a massive miss. In 22, Q2, things improved. They were still missing, but they were getting better. Q3, they fell away a little bit, but in Q4, 22, they beat. But Q1, they lost again by a huge margin. I don't like this extreme volatility between missing and beating, but it could be due to investing in the company. So they're making money and then they're reinvesting. Q2 23, they beat, and now we're waiting for the 1st of November, which is next week, to look at the earnings to see how they do. Their expectations hasn't increased or decreased, so it's pretty flat on expectations. Now, it's interesting to note that last quarter we did beat. The earnings, the expectations is slightly increased. Will they beat again? That would be good, of course. Now, one of the things I like to do is, it gets overlooked, is look who is investing in the company. Why do I do this? Because if you look at who's investing in the company, it gives you the trading sentiment. It gives you an indication on how the stock will be traded, because at the end of the day, depending on who's buying and selling the stock, that gives you an idea of how it's going to move. If it's owned by, for example, people who buy Mullen, then get ready for a bumpy ride. If it's owned by people who buy the S&P or Apple or Amazon, you can give it a bit more weight. So let's have a look at it. Invesco Mortgage Capital. Don't know much about that one, or Lithium Capital, but I do know about Ford. Old style, old school type of investor. Always loses money though. Over the last 5 years, you're down, you're making no money on it, but it's a favorite. Some people like it. I don't actually know why you'd like it. I think a lot of people get paid in dividends and stock options when they work for Ford. That's probably the people that own it. I don't know why you'd buy it. So that's a concern. If it was Tesla, different ball game, but it's Ford. Energy Transfer, don't know much about those. I know a bit about Tilray, and that is a bit of a scare. That means it's going to be volatile. People that buy Tilray tend to be very scalpy type people. They're in and out, a bit more like gamblers. Plug Power, the same. So it's got some scary neighbors. Should I put it like neighbors? Scary neighbors. People that invest in this stock also invest in some pretty volatile stocks. I don't know about the other two, so I can't comment. Anyway, let's do a back test. Now, this is important. If you're going to buy something, you've really got to look at it. Oh, before I do, I forgot to look at the chart. Beg your pardon. Okay, so when it IPO'd, you can see we were up. That's typical of an IPO. And down she comes, down she comes, down she comes, goes sideways for a while, pop up, then back down again. So it's quite volatile. That would perfectly understandable with the people that buy the stock. It's going to be that kind of stock anyway. It's got a strong buy at this price. It's still losing money though, so you're not buying anything right now that's making money, and that is the key right now. Now we know some stocks that we have don't make money, but the golden rule at the moment is stocks with value that make money is the way forward because of such high risk. And of course, if they're investing and they're borrowing money, the interest rates is putting a lot of pressure onto these new companies. Anyway, the most important thing, now we kind of know what the company is, what the general financials are. We've not looked at the full financial breakdown, but we've got a basic idea, is we need to look at the back test. Now, this is the most important thing you can do, because you can go from I've gone from 1992, which is a year after its IPO. That way we're not getting the pot. We're getting a bit more, settled in. 1992 to today, until today. Put $10,000 in this, or $10,000 in the S&P. Now, of course, the S&P is the benchmark, what you compare against, because at the end of the day, if you make more money on the S&P without any risk and a dividend, why would you even bother buying a growth stock? What's the point? Why have the risk? There isn't no point. However, new companies can have faster growth. That's why you buy certain stocks too, because you've not made enough money to be able to just sit on the S&P or sit on dividend stocks. You need something, all right? So let's have a look. I put 10 grand in DBRG and I put 10 grand in the S&P, 100% portfolio of one and 100% portfolio of another. So it gives me an idea of how I can compare the two. So if we scroll down and have a look at it, let's have a look. Well, $10,000 in DBRG, you've got yourself $3,000 from when it started until today. Well, that's not very good, is it? Whereas in the S&P, you've made double the amount. You've made from 10,000 to 24,000. So it's a no-brainer. One's made 10%, one's lost 12%. Well, it's kind of sorry, not 10%, I beg your pardon. One's more than doubled and the other one's lost. So it's quite obvious which is the way to go there, right? However, let's look at the chart and let's see on certain key dates. We can't go back as far as 2008. We can't see the crash there, but we can see March 2020, and we can see that the S&P, which is in red here, did drop a lot more than DBRG. Now, that could be something to do with the fact there are certain stocks. Moderna did well in COVID, of course. It was provided a vaccine. Peloton did well. Now it's collapsed. We saw Carvana. We saw other stocks did well. Zoom did well because people's behavior was different. So it's good the fact it didn't go down as much. However, if it's got a more resilience in a downturn, then perhaps we want to see what it would do. It would do more in good times. Well, the reality is it didn't rise the way the S&P did. It kind of sort of went up a little bit and then down a bit. So there you go. You can get an indication. So initial look at this without going into the financials, without researching the CEO, without researching the debt, which of course you need to do, I would look at it and go, well, what's the point? I would rather buy the S&P. However, if you know more about this stock, perhaps if it's a favorite of yours, you understand it more, you know the financials are good, you know the debt situation is good, you know the CEO and the management team are very successful in the past and they're likely to do well, and you like it, then maybe. My strategy would be then I would allocate a lower amount of my portfolio because this is high risk, hasn't done very much. I might say I will allow 5% of my portfolio to ride on DBRG. So let's say 5% of my portfolio is $10,000. Let's just say 5%. So I would say, okay, I will enter now because now seems quite a good time. If we look at it, it's quite a good time overall. It's near its low. I would perhaps put 3,000, so 30% of my allocation in. If we get a 5 to 10% drop, I would add a bit more, but I would keep some on hand of my allocation so that way I've got more money to buy if it does drop further. If I then have my full allocation in pretty quickly, I would be looking to try and trim back some, make a small profit. If I'm doing it on my Roth, I'm not paying any tax, which would be a much preferred way of investing in something like this. You're not going to want to hold it perhaps long term. You might want to take some money off the top to do it on your Roth so you won't pay any tax. Trim back a little bit, make yourself 5-10%, and then you've got that money to buy bigger dips, and ultimately then you could end up with owning the stock for free. If it keeps performing like this, just keep trimming off the top, and that way you can manage your, the allocation of your portfolio. That's how I would probably play it. It's not one for me right now. I don't know enough about it, but there we go. We've covered DBRG for one of our members. It's a full a basic back test without the financials. If you'd like to be a member or anything else, join our shows. Click above my head for more information, and there'll be more links and information in the description. Over here, I'll post some videos which you might find useful in relation to DBRG, upcoming major events. And I hope to see you on another show. Until next time, as always, take care of yourselves and each other.